Hi, my name is Mark Hemby. I'm a senior advisor with Saltmarsh Financial Advisors. I'm a CFA charter holder and have 20 years experience in the financial industry. So in investing, we talk about stocks and bonds, and sometimes you'll hear the words equities and fixed income. Stocks are referred to as equities, bonds are referred to as fixed income. To distinguish between the two, if you think about investing in a company, you can invest as an owner, which represents equity, or you can invest as a bondholder. Essentially, a bondholder is the same thing as lending money to a company or to a government. And whereas equity represents ownership. Now, why a stock is more risky than a bond is when a company goes in bankruptcy. When the assets are distributed from the bankruptcy court, the bondholders will get paid before the equity shareholders. So in a lot of cases, if there is a bankruptcy, equity holders won't get any money. And so that makes them more risky. But with that comes more reward. You can never separate the two in investing, risk and reward. Where you have more risk, you have a potential for more return. Where there's less risk, you have less potential for a return. Yeah, some important factors would be, one, what is your risk tolerance? If you have a higher risk tolerance, you may have a higher allocation to equities or stocks. If you have a lower risk tolerance, you might have less. Another important consideration is your time horizon. What are you saving for? Are you saving for retirement? If you're young, you might have 40 years till retirement. Are you saving for a house, to buy a house? Then maybe your time horizon is 5 years. If you're saving for your child's education and they're just born, you've got 18 years to invest. So it really kind of depends, not just your risk tolerance, but also your time horizon for that investment. Yeah, so in investing, we talk a lot about asset allocation. And asset allocation is how much you have allocated to stocks or equities and how much you have allocated to bonds or fixed income. And that is the number one determinant of your overall return over a long period of time. So for instance, the classic 60-40 portfolio, you hear that a lot. That includes 60% equities, 40% fixed income. If you were to have, say, 80% equities and 20% fixed income, you would have a higher risk. You'd have a riskier portfolio, but you'd have a higher potential for return in that case. And the opposite would be true if you had 20% in equities and 80% in bonds. You would have a lower risk, less risky portfolio, but less potential for return.